So here we've got a section B question. What we're going to try to do is to ensure that A, we pick up our professional marks by laying out our answer in such a way to make it easy for the marker to give us marks. And in my view, using bullet points or using some form of index is a really good way of addressing that. So let's go through each part of the question in turn. And what have we got? Well, we've got part A is our wheat contract. And it says Margie wishes to treat this transaction as a share-based payment under IFRS 2. Well, the first thing I would say is this is not a contract that is covered by IFRS 2, and the most important word in your written answer is the word because. Because firstly, Margie is not taking delivery of the wheat. So you can have a share-based payment contract where you are using the shares as a means of physically paying for something to which we take delivery. Secondly, there is a net settlement rather than Margie making a payment for goods or services. So remember, the IFRS 2, the title of IFRS 2 is share-based payment. Well, we're not actually going to have a share-based payment. Here we've got some form of swap. So instead, we should treat the contract as a derivative, again, using my favourite word because. And the reason why I like because it drives through the answer. It forces us to express ourselves. And then I'm going to take another bullet point approach. Why is it a derivative? Because the value of the contract is determined by the value of something else. What is that something else? It's the value of Margie's shares. Secondly, the initial cost is negligible compared to the overall value of the contract for the 350 tons of wheat. And thirdly, it will be settled at a future date. Can you see that every time I write one of these points, I'm trying to do it within my 2-line maximum? And because I'm separating out all my points, at the back of my mind, I'm looking to get 7 points approximately as far as the answer is concerned. So the derivative should initially be measured at fair value at the date the contract is signed. This would appear to be 0, as presumably the 350 tonnes of wheat is the same value as the shares in Margie. At the SFP date, we calculate the fair value of each element of the contract and the overall gain stroke loss is taken to P&L. Now it does say that Margie wishes to treat this transaction as a share-based payment, and Margie is entered into the contract as part of its hedging strategy. This would not qualify as a hedge because we are not taking delivery of the wheat. Hedging only applies in relation to assets we already own or transactions that are highly probable. Because we are not taking delivery, this contract is not for a highly probable asset. So every time I put something down, I'm trying to pick up bits and pieces in respect of the question. I'm trying to pick up clues. I'm not really sure how expert I am on this particular topic, but I'm picking up key words from the question. We're not taking delivery, so therefore it rules out hedging. It talks about IFRS 2, so let's talk about IFRS 2. What are we doing? Well, we're doing a swap. The value of our shares for the value of their wheat. One of those is going to go up or down in value more than the others. So therefore, it's a derivative. There's 7 marks going. Have I got 7 points? Well, yes, I have. So let's now move on to part B. And part B is for Antalya. What's happened is that we have acquired 100% of Antalya in a business combination. Antalya is therefore our subsidiary. It's granted a share-based payment to its employees with a 4-year vesting period. And what they have had to do is that they've done their part of the work. The fair value of the work that they've done, of the award, is 20 million. And Margie is obliged to replace the share-based payment with one of its own. So, Margie has a commitment because it is obliged to replace the share-based payment scheme with one of its own. Therefore, the scheme should be taken into consideration at the acquisition date. This will increase the liabilities of Antalya at the acquisition date by 20 million, which is the fair value at control point. Therefore, goodwill will be increased by 20 million because the share-based payment scheme, and it's perfectly acceptable to write SBP, reduces the net assets of Antalya. Now I'm looking here for 6 marks. It says Margie issues a replacement award that does not require post-combination services. The replacement scheme offered by Margie would appear in the group SFP at a value of $22 million. The extra $2 million is shown as an expense in the group income statement in the post-acquisition period. So once again, I'm thinking 6 marks, I've got around 6 points. I've got my initial point followed by 5 bullet points. I'm trying to ensure that each time I write something, it is potentially going to earn me a mark. And the other thing which I'm very keen for you to do in the exam is this question is called Margie. It's amazing how many students in the real exam never mention the name of the company. Well, try to personalise your answers by using the names of the parties involved. You're trying to pick up those extra 2 presentation and style marks. This is one way of generating those marks. Part C. Share issue to employees and grief. So what does it say? Margie issued shares during the year. Some of these were subscribed for by employees who were existing shareholders, and some were issued to an entity called grief. As soon as I see the word "and" within the question, I'm thinking, right, I've got 2 questions here. So let's break my answer down into 2 components. So the shares issued to employees are not accounted for under IFRS 2. This is because the employees are existing shareholders Therefore, they should simply be dealt with as buyers of new shares in Margie and the double entry is debit cash, credit share capital, stroke share premium. Now, Grief owned 5% of Margie's share capital. Before the shares were issued, Margie offered to buy a building from Grief and agreed that the purchase price would be settled by the issue of shares. So, in relation to Grief, this could be seen as a share-based payment because Margie is issuing shares for an asset that will actually be delivered. The property should be measured in the financial statements at the fair value of the shares issued by Margie. So what are we going to do here? We're going to debit PPE and credit share capital stroke premium. So that's part C. We then move to part D, and this is our options to employees. This scheme is covered by IFRS 2 because Margie is offering employees shares in the company at a future date, which is the vesting date, dependent upon a vesting condition which is market based. Because our vesting condition is that the share price has to get to $15. The grant date is when the scheme commences. Which is the 1st of December 20x1. At the start of the current financial year, what happened? Margie estimated at the grant date that the expected vesting period would be 4 years. So at the start of the current financial year, the vesting date was estimated to be 4 years. Therefore, at the 30th of November 20x3, the total expense was, here we're going to employ our normal calculations, it's going to be 100 employees, they're each entitled, 100 options times 4,000 employees. The fair value of the shares was $10, and we were 2 years into a 4-year scheme. So the total expense at the start of the year was $2 million. Oops. At the 30th of November 20x4, the share price has reached the target figure of $15, and so the vesting period is only 3 years. Because what was our vesting condition? It was to get to $15 in either 3 years, 4 years, or 5 years. Well, we thought it was going to be 4 years, so we always base things on our probable expectations, but sometimes our expectations are wrong. The total cost at the 30th of November 20x4 is therefore, how do we do that calculation? It's now going to be 100 times 4,000 times $10, and we are 3 years into a 3-year scheme. So our total cost is therefore $4 million. So the increase in the cost in the year of 4 less 2 million is charged to the income statement. The other side of the entry, in relation to the share options, is credited to equity directly, usually in other components of equity. So again, I'm looking to see what I've done here, and I've got around about 6 points. Every time I go through a section B question, I'm thinking all the time, how many marks are allocated, make 1 point at a time, and roughly in my head I'm thinking I'm going to get 1 mark per point. If you can keep each point to around about 2 lines, remember I'm writing in Arial 16 here, so I'm writing quite big. So I'm not actually writing a huge amount. It might appear to be. Well, it's quite more than I thought. I'm a quicker typist than I thought.